What if I told you a single Colombian ETF has outperformed the S&P 500 by fourfold this year? The GXG fund is up 76% YTD, while Wall Street's flagship index is barely nudging a 12% gain. Most investors still picture Colombia as just coffee and soccer, yet the numbers screaming from the data tell a different story. In the next 8 minutes, I'll peel back the hype, show you why nearshoring is turning Medellín into a tech hub, and reveal the real estate bargain that could supercharge your portfolio. Stay tuned. By the end, you'll know the exact entry point that could flip 10K into 30K within 24 months. Welcome back to Latam Money Secrets. I'm Alex, your guide to the hidden gold mines of Latin America. Picture this. You bought a modest 2-bedroom condo in Medellín's El Poblado district for 180K back in 2019. Fast forward to today, that same unit is fetching 260K on the market, delivering a 44% total return, far outpacing a comparable Miami condo that sat at 800K and barely moved. That isn't luck, it's the power of emerging market dynamics. In today's episode, you'll learn 1. How Colombia's macro numbers translate into real-world buying power for you. 2. The 3 fastest-growing sectors where a 10K stake can earn double-digit returns. 3. The exact price per square meter gap between Medellín and major U.S. cities, and how to exploit it now. Let's dive in. The real picture. Colombia's economy sits at $457.4 billion in 2025 GDP, growing at 2.6%, a notch above the United States, which eked out roughly 2% growth the same year. On a per capita basis, that translates into an extra 250 million of economic activity every quarter, a steady stream of jobs and consumer spending power. Inflation is the elephant in the room at 5.1%, but put it side by side with the US at 3.1%, the UK at 3.4%, and France at 2.8%. The gap isn't a runaway crisis. It's a manageable premium that the Banco de la República keeps in check with credible policy tools. For a portfolio, that means real returns aren't being eroded as quickly as they would be in a 7-8% inflation environment. Foreign direct investment poured $13.7 billion into Colombia last year, a clear vote of confidence from global capital. That influx fuels infrastructure, tech parks, and the very sectors we'll explore next. Here's the number that matters most. The GXG ETF past performance does not guarantee future results. The flagship vehicle tracking Colombian equities has surged 76% YTD, dwarfing the S&P 500's modest 12% climb. That's not a fluke. It's the market pricing in a wave of nearshoring, renewable projects, and a consumer class hungry for modern goods. Bottom line, Colombia's growth rate, modest inflation, and massive FDI inflows create a fertile ground where your dollars can stretch further than in most developed markets. The opportunity. While U.S. investors are battling over the last slice of the S&P 500 pie, a quieter, more lucrative banquet is being set up in Bogotá, Medellín, and Cali. Let me break down 3 insider-grade plays that are already delivering 12-18% upside, and how you can get a piece of the action with a modest outlay. 1. Consumer staples and retail. Colombians are spending more on groceries, personal care, and e-commerce. Companies like Almacen's Exido and emerging grocery delivery startups are projected to generate 12-15% annual returns. A 10K allocation into a locally focused consumer ETF or directly into a mid-cap retailer could net $5K per year, compounding as the middle class swells. 2. Renewable energy infrastructure. The government's 2030 Clean Energy Roadmap promises $30 billion in new solar and wind capacity. Investing in the Renewable Energy Fund, RefCall, a debt instrument with a 10-13% 5-year yield, means a 10K stake could become $3K in 5 years, plus the environmental bragging rights. 3. Financial services, Bancolombia and FinTech. The banking sector is undergoing a digital overhaul. Bancolombia's mobile-first strategy and homegrown fintechs are delivering 14-18% returns over a 3-year horizon. A 10K position in Bancolombia ADRs or a fintech venture fund could balloon to $18K in just 3 years. Now compare real estate. In Miami, a comparable 2-bedroom condo in a prime neighborhood costs $800K and yields roughly 4-5% after expenses. In Medellín's El Poblado, You can snap up a 150 SQM apartment for $180K, rent it out for $1,200 a month, and collect a 8-9% gross yield, almost double the U.S. cash flow, with upside potential as the city's tech ecosystem attracts multinational firms. These three sectors, paired with a real estate play, form a triforce of growth that can diversify your portfolio, while delivering the kind of returns you rarely see in mature markets. One opening graphic, bold text, 48-76% YTD, Colombia's secret ETF, animated chart. 2 host on camera, direct eye contact, delivering the hook. 3 split screen, GXG ETF, past performance does not guarantee future results. Line versus S&P 500 line, highlighting the gap. 4 map of Colombia, highlight Bogotá, Medellín, Cali with pop-up icons for GDP, growth, inflation. 5 bar chart, Colombia GDP 457, 4B versus US 26T, scaled for perspective. 6 inflation comparison graphic, stacked bars for Colombia 5, 1% US 3, 1% UK 3, 4% France 2, 8%. 7 footage of coffee farms, quick cut to counter the just coffee myth. 8 drone shot of Medellin skyline, emphasize tech hubs and modern infrastructure. 9 on-screen text, 13, 7B FDI inflow, why it matters. 10, host walking through a Medellin co-working space, illustrate nearshoring vibe. 11, graphic of GXG performance, 48, 76% YTD highlighted with upward arrow. 12, consumer staples logos, Exido, Carala, with sales growth percentages. 13, animation of money flow, 10K right arrow 1, $2 1. 5K annual return illustration. 14, renewable energy sites, solar farms in La Guajira, wind turbines in Guajira region. 15, debt instrument visual, ref call bond certificate with 10-13% yield tag. 16, banking and fintech icons, Bancolombia app UI, fintech startup logos. 17, side-by-side condo comparison, Miami 800K versus Medellin 180K, with rent overlay. 18, rental yield calculator, on-screen math showing 8-9% yield. 19, host back on camera, summarizing the 3 opportunities, pointing to bullet points. 20, teaser thumbnail, the next LATAM boom, don't miss out, with a countdown timer graphic. Each clip runs 5-12 seconds, ensuring a brisk, high-energy pace that keeps watch time soaring. 250+ words. John's around-the-world portfolio had been glued to the U.S. Sun Belt for years. Then a friend sent him a link to a Medellin-based development that was already half-filled. The headline, Prime Downtown Lofts, 2026 delivery, 30% below Miami's Brickell price point. John did the math. He knew the U.S. market averages roughly $5,000 per M2 in Miami's upscale districts. The Medellin project advertised a unit at $1,600 per M2, a figure that appeared on the developer's public brochure. No hidden fees, just the base price. That's a 68% discount compared with the U.S. benchmark. He didn't stop at Medellin. The same firm had a sister project in Bogotá's Chapinero sector, where listings show $1,800 per M2 for a similar 2-bedroom layout. Bogotá's price is still a third of what you'd pay for a comparable condo in Sydney's inner-city suburbs, roughly $5,500 per M2 there. John's purchase plan looked like this. City neighborhood size M2, listed price M2 total outlay USD, yield estimate. Medellin El Poblado, downtown core. $121,600, $192,000, 7.9% PA. Bogotá, Chapinero, $151,800, $270,000, 6.8% PA. Cali, San Antonio, $101,400, $140,000, 8-10% PA. Backslash yield is based on projected rental demand from the city's growing middle class, and the 6% GDP growth rate that fuels consumer spending. Why does this matter? Colombia's inflation sits at 1%, still lower than the historic volatility of many emerging market rents. The central bank's credible policy framework keeps real returns from eroding. In contrast, U.S. rental yields in comparable high-cost districts hover around 3–4%, meaning John's Colombian assets could double his cash flow in half the time. John also leveraged a U.S. brokerage that offers a global real estate fund tied to Colombian property indices. The fund charges a modest 0.45% expense ratio and lets him own a slice of the market without dealing with local title registries. The takeaway? Real estate in Colombia's top metros is not just cheap. It's positioned in a growth corridor where consumer-driven demand, low construction costs, and a stable macro environment converge to create a price-to-rent sweet spot that most U.S. investors overlook. 200+ words. If bricks aren't your jam, the GXG ETF, past performance does not guarantee future results, is the shortcut. Traded on the NYSE, GXG tracks a basket of Colombian equities and sits at $42.21 per share. Its YTD return of 76% dwarfs the S&P 500's gain, proving that the market's upside isn't a fluke. Why does the ETF move so hard? Colombia's FDI inflows hit 13.7 this year, a clear sign that foreign capital trusts the country's policy stability. The sovereign credit rating remains BBB from S&P, just a notch above investment grade and comfortably above the junk threshold that scares risk-averse funds. Investors can buy GXG through any standard U.S. brokerage, Robinhood, Fidelity, Charles Schwab, no special paperwork needed. The broker handles currency conversion at the interbank rate, so John never touched Colombian pesos directly. Beyond GXG, a handful of blue-chip Colombian stocks are worth a look. Bancolombia CIB, the nation's largest bank poised to ride the fintech wave. Ecopetrol EC, the state-controlled oil champion, benefiting from higher global crude prices. Cementos Argus GRU, a construction materials leader feeding the nearshoring boom. All three sit comfortably within the BBB rating envelope, meaning sovereign risk is priced in but not prohibitive. For a diversified exposure, John allocates 60% of his LATAM equity budget to GXG and 40% to a hand-picked trio of the stocks above, balancing broad market upside with targeted upside in banking, energy, and infrastructure. 200+ words. No investment is a free ride. 3 real risks keep savvy investors awake at night. 1. Currency volatility. The Colombian peso can swing 8–10% against the dollar in a single quarter, especially when commodity prices wobble. John hedges by keeping a 10% cash buffer in USD-denominated short-term bonds and by using forward contracts on the peso when the exchange rate spikes. 2. Political uncertainty. Election cycles bring policy shifts. The last presidential race saw debates over tax reforms that could affect corporate earnings. John mitigates this by focusing on companies with diversified revenue streams, e.g., Bancolombia's cross-border digital services, and by avoiding sectors that are heavily dependent on a single government contract. 3. Legal and title registry quirks. Real estate transactions can get tangled in bureaucratic delays. John works with a local law firm that runs a title search checklist, ensuring the deed is clean before any payment. For equities, he sticks to exchange-listed securities like GXG, rather than over-the-counter deals that lack transparent reporting. Smart investors treat each risk as a separate line item, not a vague, it'll be fine sentiment. By layering currency hedges, diversifying across sectors, and using professional local counsel, John turns potential landmines into manageable variables. This is educational content, not financial advice. 150+ words. 1. Colombia's growth engine. 2. 6% GDP rise, 5. 1% inflation, and 13. 7B in FDI creates a fertile ground for both property and equity gains. 2. Real estate bargains in Medellín, Bogotá, and Cali deliver yields that outpace most U.S. markets, while the GXG ETF, past performance does not guarantee future results. 48. 76% YTD surge shows the equity side isn't lagging. 3. Risk management is non-negotiable. Hedge the peso, diversify politically sensitive sectors, and lock in clean titles. If you want to catch every one of these country breakdowns, hit subscribe. We post a new one every week. Grab the free LATAM Investors Playbook at Latam Money Secrets, BHIV, com for deeper spreadsheets and model templates. Next week, I'm unpacking Brazil's green energy boom. See you then.